Is the next crash coming? Find out what to do before it's too late. We live in a time of great economic uncertainty. Constant news about falling stock markets, rising inflation, bank failures, and depreciating currencies makes us wonder, are we on the verge of another financial crash? If you've ever asked yourself that question, stay with me until the end of this video. Today, we're going to understand how these collapses happen, why they are more common than they seem, and most importantly, what you can do to protect your money and your financial freedom. Go ahead and like this video, subscribe to the channel, and turn on the notification bell so you don't miss our upcoming content on finance, investing, and wealth protection. Shall we dive in? 1. What is a financial crash anyway? A financial crash is an abrupt, significant, and often unexpected drop in the prices of financial assets, such as stocks, bonds, currencies, or real estate. Unlike a simple market correction, which is natural and healthy, a crash is marked by panic, evaporating liquidity, and a systemic loss of confidence. A crash can bring down markets within hours, drag companies into bankruptcy, and, in more severe cases, plunge entire countries into recession. What's most concerning is that it can start with something seemingly small, like a bank failure or an interest rate change. 2. How does a financial crash happen? While every crash has its specific causes, most follow a relatively predictable sequence. Let's break down the cycle. 2.1. Euphoria phase. It all begins with a period of rapid economic growth. Credit is cheap, consumption rises, and assets increase in value quickly. This generates optimism. Investors start to believe that this time is different. Picks to 2.2. Bubble formation. The continuous asset appreciation creates a bubble. Prices rise not because of strong fundamentals, but due to speculation. The so-called herd effect. People buy simply because everyone else is buying. 2.3. Bubble burst. An unexpected event. A political crisis, a monetary policy shift, or a major corporate bankruptcy can burst the bubble. The first to notice sell, and others follow. Collapse happens within hours or days. 2.4. Contagion. In a globalized financial system, a crisis in one country can spread quickly. International investment funds pull out money, currencies devalue, and banks stop lending. The domino effect takes over. 3. Historical examples of financial crashes. 3.1. The Great Depression, 1929. Perhaps the most famous. In 1929, the New York Stock Exchange collapsed, plunging millions into poverty. It followed a credit-fueled post-war bubble. 3.2. Asian Financial Crisis, 1997. Started in Thailand with the fall of the baht and quickly spread. Dollar-denominated corporate debt led to widespread defaults. 3.3. Dot-com bubble 2000. The tech stock mania sent the Nasdaq soaring. When it became clear many companies had no profits, the market crashed. 3.4. Subprime mortgage crisis 2008. Fueled by irresponsible mortgage lending in the US, it led to Lehman Brothers bankruptcy and a global meltdown. Over $50 trillion in market value was lost. 3.5. Pandemic mini crash. 2020. Fear of the unknown triggered a 30% plus drop in major indices in just 30 days. One of the fastest crashes in history. 4. What are the warning signs before a crash? To protect yourself, stay alert. Here are common signs. 4.1. Excessive valuation. When companies with modest profits trade at extreme multiples, it's bubble territory. 4.2. Too much leverage. When banks, companies, and individuals rely too heavily on credit, systemic risk grows. 4.3. Euphoria and overconfidence. Phrases like "it has never been easier to make money" or "the stock only goes up" are red flags. 4.4. Overconcentration of investments. If everyone's putting money in the same asset class, there's risk of a sharp reversal. 4.5. Tight monetary policy. Fast interest rate hikes make credit expensive and burst bubbles. 5. What happens to the economy after a crash? Recession, confidence plummets, businesses close, unemployment rises, currency devaluation. Capital flight weakens the local currency. Inflation or deflation. Depending on the government response, we might see hyperinflation or prolonged deflation. Increased inequality. Those with protective assets preserve wealth, while smaller investors suffer most. 6. How can you protect yourself from a financial crash? Practical strategies every investor should follow. 6.1. Smart diversification. Spread investments across stocks, fixed income, gold, real estate, and even crypto. Never put all your eggs in one basket. 6.2. Risk-aligned allocation. Your portfolio should match your risk tolerance. You panic over losses, avoid overexposure to volatile assets. 6.3. Emergency fund. Keep at least 6 months of expenses in safe, liquid investments to avoid selling at a loss. 6.4. Currency protection. Dollar-based investments help safeguard your wealth during local crises or currency devaluation. 6.5. Regular rebalancing. Review your portfolio every 6 months or after major market moves to avoid overconcentration. 6.6. Continuous learning. Crashes expose uninformed investors. Study, read books, watch videos, and learn from past mistakes. 7. The psychological side of a crash. The real danger is in your mind. Investing during a crash is emotionally tough. Fear dominates. Many sell at the bottom and buy at the top. So, avoid impulsive decisions. Don't overconsume news. Stick to a clear strategy. Consider automating part of your portfolio. As Warren Buffett said, the market is a device for transferring money from the impatient to the patient. 8. Case study. A deep dive into the subprime crisis. Steps of the 2008 crisis. ONE U.S. housing bubble 2002 to 2007. Easy credit and mortgages given to people with no stable income. 2. Debt securitization. Banks turned mortgages into financial products and sold them globally. 3. Fed raised interest rates. Defaults exploded. 4. Banks and investment funds collapsed. 5. Crisis of confidence. Markets froze. 6. Massive government bailouts. But the damage was already done. This crisis taught us the importance of knowing what is behind your investments and not blindly trusting institutions or past returns. Financial crashes aren't rare. They're part of the economic cycle. The key isn't predicting the next one, but being prepared for it. With knowledge, strategy, and discipline, you can weather any storm and come out stronger.